Closing bell 4 minutes away. Dow, S&P, and Russell are on track for a record close, and the NASDAQ is right there, up 2 points. So we're quad-tastic. Who's helping the Dow notch its 14th record this year and also hitting record highs? There are 4 Dow components right now hitting records: Cisco, IBM, Apple, and Goldman Sachs. But of course, everybody wants to enter the tech trade right now because of the strong growth from artificial intelligence companies. But tech is only one of the 11 sectors composing the S&P 500, the broader market. And while where to invest is always key to market success, knowing where not to invest right now is equally valuable. Today's Countdown closer has the sectors he says you should be staying away from. Joining me now, U.S. Bank Asset Management National Investment Strategist Tom Hainlin. He manages more than $565 billion. Okay, I just asked Constantine, I don't know if you know, but I was talking to Constantine Buller of Sequoia, and I said, what won't you invest in? And he said, it's more better to talk about, what we will invest in, big problems that have big markets. What areas are you avoiding right now that you really feel people should stay away from?
Good afternoon, Liz. It's an interesting question. We think it's still way too early to get defensive. So, you can have investments in consumer staples or those more defensive parts of healthcare and utilities. But there's been a lot of skepticism about this economy and this market rally. But we think there's still strength in consumer spending and business investment. And again, just way too early, we think, to get overly defensive and not participate in this.
Okay. So you're saying just go with the flow, and the flow is fast. The momentum is incredibly powerful right now. So why step in front of it?
Well, and Liz, also, technology is 40% of the S&P 500, but another 10% is industrials and materials sectors. And, if you think about the big themes, it's not just artificial intelligence, it's bringing manufacturing back to the United States, and it's the continued electrification of our economy. So that brings it from the digital to the physical, and that's engineering and construction. Those firms are sitting in those industrials and materials sectors, which are, again, a pretty part of the growth sectors of the economy.
Yeah, the XLI right now is up about 1%, and if we stretch it out over 1 month, it's actually flat. But I think that at least you're not buying it, certainly at a 1 month high. There's been so much froth there. Staples, consumer staples. These are things you have to buy versus want to buy. You like these here?
Well, it's always a good part of the portfolio, but again, that's where you kind of think if you're about to go into a recession, and investors and consumers are more thinking about not spending on discretionary things like restaurants and travel, but those more critical, things like food and gasoline. That's when those sectors tend to do pretty well, and we think that the combination of tax refunds and wage gains and savings earned during COVID are really helping consumers continue to spend on those non-staples, those more discretionary items, and continue to participate there.
Yes, especially when gasoline is as high as it is, although it is off the peak of the wartime prices. As we get ready to hear this closing bell, we are seeing record after record here, and this market ceases to amaze people. How about you? You've been around long enough to watch this type of thing.
Well, over time, earnings drive stock prices, and you've seen just tremendous growth in earnings as companies have invested in productivity and margins. And again, businesses are investing, consumers are spending, and that's just a great setup for stock prices to move higher. We're going to get into a quiet period now after first quarter has ended. It'll be a couple of weeks before second quarter earnings come in, and that's when we'll get a lot more information about what the rest of the year looks like.
Tom?